Hey guys, JC Peretz here of allstarcharts.com, and I just wanted to take this opportunity to take a look at a few charts. I brought a couple with me that I think are good to really take a step back and really identify the direction of the primary trend and what we should really be doing. Should we be aggressively buying stocks? Is this a sort of environment that is the springboard to another 20-25% of upside in the major indexes, or should we continue to expect most stocks to stay under pressure and range bound at best, which is what we've seen from the majority of stocks since February and in some cases since May? So let's take a look. So this first chart is the Dow Jones Industrial Average, going back to the low after the COVID crash, up to the recent highs. You know, we got that peak in mid-May. And I just want to point out the New Yorker magazine. I always like to do this because they do such a great job, the journalists, of aggregating public sentiment and public opinion, and in a lot of cases, consensus. We can use that as information to really confirm a lot of the other things that we're doing that are more data-driven. But I think the New Yorker absolutely nailed it. You know, at the end of March, when the market was literally bottoming and stocks were, it was a time to be buying stocks, not selling them, we had one of the most pessimistic magazine covers of all time. Grand Central Terminal, a place I have visited many, many times, and just completely empty, right? A very, very gloom and doom magazine cover at the exact time that we should have been buying stocks. And then what do we see more recently when stocks were peaking in May? A lot of the international markets and cyclical sectors, what were we seeing? The most beautiful, just a great optimistic view of the world, just a family walking out of their home, going to the big city for the first time after being locked up, very, very optimistic, just classic behavior of how we feel near lows and how we feel near tops. And now when we're looking at sentiment, not only is it the New Yorker that's incredibly optimistic, when you look at the University of Michigan surveys, these are asking the question in terms of whether or not pollsters believe that stocks are going to go up over the next 12 months, over the coming year. And we're at levels well above the 2015 highs, well above the 2007 highs. In other words, just elevated levels of optimism that don't tend to come near bottoms in the stock market, but tend to come near tops or periods of digestion. And we're just not seeing any bears. Here we're looking at the financial advisors, and what we're seeing is just a lack of bears. So until we get a pop in bears, 16% only of bearish financial advisors, really want to see a spike in that before feeling incredibly confident that sentiment has reset, right? So I want to show off our checklist. This is our risk on, risk off checklist. I particularly love this because it includes other asset classes, not just the stock market. We're looking at credit spreads, Aussie yen, different countries around the world, including Germany and Australia and Canada, that are at key pivot levels. So right now, we're only at about 32% of our checklist on the risk on side of the equation, which really matches up with a lot of the other things that we're seeing, of course. So here's the question that, I think that we should all be asking, not just us, but the question that we should all be asking is, whether this consolidation that we're seeing in equities, in many cases started in February, you can argue in other cases it started in May, but regardless, here we're looking at an equally weighted chart of the S&P 500. So it takes out, the heavy cap weightings, those mega cap names that are driving these indexes. The equally weight averages really tell the current story really well, I think, in my opinion. The sideways mess is that story. So the question is, the bull case, this is a rectangle or some kind of range-bound market that should resolve in the direction of the underlying trend, which is, we all are well aware, was up prior to this, or is this more of a distribution? That seems to be the big question. For me, the hard answer has been my answer, is that messy for longer, right? Because we've had this question for some time now, since March. So it's not a new question we're asking. But we're just seeing further and further evidence and more sectors and indexes and important areas looking like this, sideways choppy mess. So I want to drill down into the financials. Regional banks holding below their 2018 highs. I think it's a big problem for stocks, for small caps, for interest rates. It's probably good for bonds. So that's one thing that we're watching. Bonds are up now, working on their fourth consecutive month of gains, U.S. Treasury bonds, as the U.S. dollar has also seen a bid. So my question is, if things are so great and stocks are going to do so well going into the end of the year, why do we keep seeing that bid in the defensive areas, particularly bonds and the US dollar? So if regional banks are below the 2018 highs, I think that's a big problem. I think if you're bullish stocks, you're being very aggressive, you think rates go higher, you're selling bonds, you want to be buying stocks, I think you really need to see regional banks back above those 2018 highs. You can watch KRE there. And then when you compare it relative to the rest of the market, we're seeing the same thing. Former support here in regional banks on a relative basis, turning into resistance. These are just characteristics of the type of environments where bonds tend to do better than stocks. And that's precisely what we've been seeing. So 1.4 to me is that level. This is the US 10-year yield near 1.4%. Those were the lows in 2012, lows in 2016, lows in 2019. And then we broke last year. And now here we are returning to the scene of the crime. So if we're below 1.4%, I think that financials and stocks in general are probably guilty until proven innocent. If you think that the cyclicals are really going to make a comeback, you're probably going to get that international participation as well. If you're long all those things, you think all those things are coming back, you probably want to see the US 10-year yield holding above 1.4%. That's what I'm looking at there. But the trade has been bonds, right? This was going on for, early since, March, April, we were buying these things. And even the options trade, long the September 117 calls, they were only going for 55 cents back in May. So this trade has really worked out. And I think the big lesson is, forget all that stuff, market breadth and sentiment, forget all that stuff. Just real clean support and resistance. This former level of overhead supply broke out. We came back, retested it successfully. Former resistance turned into support. Pretty classic stuff. So we don't really have to get that fancy. And then, just to show you that I'm not all global macro, top down, international, intermarket, like, sure, we do a lot of that, but we do a ton of bottoms up work as well. 2 to 100 Club dropped this week, one of my favorites. What we're specifically looking for are the next $100 billion stocks. That's the idea. So they come on our radar as soon as they graduate from small cap and enter mid cap status above 2 billion. Go ask any of the old timers and they'll tell you that some of their biggest winners or a lot of their biggest winners throughout their careers have come from mid caps. So we really want to treat the mid caps a little bit special. And here, we always like to stay one step ahead of the game, or we try anyway. So as soon as they graduate from small cap into mid cap, boom, they jump on our radar. And that 2 to 30 billion is really our sweet spot where we could still capture a lot of gains before they get to 100 billion. So here's this week's scan. We're sorting by new proximity to new highs. So really, making sure that the ones showing relative strength are standing out. And you guys who have been following along for a while, this was a big winner for us when it was breaking out last year in the fall. Hit our target near 486 and has really been consolidating for most of the year. Shocking. What else is new? We're seeing that in many areas around the market. So, in my experience, the ones that are pressing up against highs when the market is under pressure, there's a reason for that, right? There's a bid. There's accumulation taking place underneath the surface. And I think Tyler Technologies is a great example. For above 486, I like it long. Below 486, it's suspect. You're probably signing up for a headache, right? Because you're still in this range, right? I don't see, you got downside risk, you got opportunity cost, like just nothing I want. So below 486, which puts us below the early 2021 highs, we're below that, leave it alone. Above 486, I like it long with a target of 677. A lot of upside coming out of this base, especially if relative strength breaks out as well. My suspicion is it does. So, when we do the 2 to 100 club and other scans as well, it doesn't mean that we're going to put on the trade that day or even the next day. We want to be alerted to it, right? Set our targets. We want to be buying the breakouts in these names. So anyway, I hope this gives you some insight as to the sort of analysis that we're doing here every single day. If you're interested in more, say what's up at All Star Charts. Thanks, guys.